Treasury Secretary Janet Yellen issuing a warning this week about the dollar amid the debt showdown in Washington. Ahead of her trip to Japan for the G7 meeting, she said that a default could have an adverse impact on the dollar as the world's reserve currency. And it also comes at a time where it's already under threat amid the rise of the yuan. Joining us now, we want to bring in DoubleLine Capital Portfolio Manager Bill Campbell, who just wrote a paper on this topic. Bill, you're the perfect person to speak to about this. So we talk about a time right now where we are in a period of rapid global change. Are we starting to see already the dollar lose its dominance? And how so?
Well, first of all, thank you for having me. And I would say absolutely we are. We've actually been seeing this for a while. But I would like to expand the thinking on, the reserve currency status from, the crown being handed from one country to another to moving instead to a system of bilateral payments where I think what we're seeing over the past several years and increasing this year is countries are signing memorandums of understanding, such as between Brazil and China, where they're agreeing to disintermediate the dollar from the settlement of their trade and investment and instead, settle in their own currencies. And this has multiple benefits for the countries outside of the United States. The most obvious is that savings when you export a good or a service and you receive a foreign currency, you need to figure out what you're going to do, with that foreign cash. And most of the time, you're going to go and buy a financial asset in that country. And what we've seen over the past several decades is many emerging markets have really moved themselves out of low income status to middle income status. They've developed broad and diversified economies. They've seen capital deepening, meaning they've seen their financial markets grow where they have domestic debt markets and strong domestic equity markets. And in a way, this is a natural progression to be able to settle trade in your own currency and then have your trading partner be able to invest back into your country, which supports consumption, investment, and growth and further development, going forward. Yeah. So that's what's happening in addition to some of the cyclical factors that, we're seeing.
Yeah, and Bill, to a certain extent, we've been talking about the potential of the dollar losing its dominance for some years now. It feels like last year was a big flashpoint, though, when you think about what happened with Russia, how quickly Western countries were able to move to freeze out Russia and its assets. Can you speak to that and to what extent that accelerated the thinking of some of these emerging markets who said we can't just be holding our debt all in dollars anymore?
100%. I think you hit the nail on the head that the sanctioning of Russia debt, hit on many levels, the most obvious of which is, the quick weaponization of the dollar, that has been discussed, that countries are saying, wow, we could actually have all of our dollar savings effectively frozen and unusable. But think about it from a U.S. saver standpoint. A lot of 401ks, a lot of institutional money managers invested in Russian sovereign debt, for example, because it's a large part of many of the international indexes. And all of that money was effectively frozen and, defaulted on as well. So that actually hurt the U.S. savers and U.S. retirees. So, from a diversification standpoint, not only from the international, but from the domestic side, too, you start to wonder, does it really make sense to have all of our savings tied up in a system that, you could effectively be frozen out of? The final element of it is when you are dependent on a single world currency for all trade and financial settlement, you lose your independence in foreign policy. So, for example, Europe, some of the European nations may not have wanted to take as aggressive a move as the United States wanted to, against Russia due to, energy linkages and energy dependence that they had with Russia. But in effect, they had to because the United States forced it. Emmanuel Macron actually made statements when he flew back from China, effectively saying that he lost his independence on foreign policy because of that. So for those three reasons, you can see why the reserve currency status is threatened by that action that was taken.
Bill, the natural question here is who then replaces the dollar? I mean, the Chinese yuan one that people have looked at, but I'm looking through your paper here. You've made examples of Brazil as well as Malaysia. How much of that has to do with the dollar and the U.S.? How much of that has to do with the pressure coming in from China saying, look, the debt needs to be held in yuan if you want these big deals? I mean, they have been pushing for that for years, especially through Belt and Road.
Okay, I think there's several items there, and you hit on some very key points. First of all, China absolutely wants to push for more settlement in their currency, as that gives it more freedom internationally to engage in foreign policy, foreign trade outside of the U.S. periphery. But secondly, bilateral trade goes in both directions. So, as much as there's imports from China from these countries, there's also from Brazil exports of commodities to China. Then the Chinese hold Brazilian reais. That savings of reais gets reinvested back into Brazil if the dollar is disintermediated. That savings that the Chinese invest back into Brazil gets put into their financial system and eventually works its way through the investment and the consumption channels, boosting the economy of Brazil. So it's a symbiotic relationship when you start looking at a bilateral system of payments whereby we disintermediate one single currency as the de facto settlement currency. And we move and allow countries to settle bilaterally with their own currencies without having to use a third independent currency to settle. And again, I think the benefits that are going to be reaped from that present a lot of opportunities for international investment, especially emerging market investment over the coming years and decades. And I think from the standpoint that over the past decade and a half, the U.S. really has been the only show in town. A lot of foreign savings got invested back in the U.S. As we've seen, there was last year about $25 trillion of portfolio investment from outside the United States sat in the U.S. But now what we've seen in the past year is many local equity indices are doing just as well, if not better, than the U.S. index. And if we have currency weakness, that's going to be a tax on that savings as well. And the change in monetary policy, increased monetary policy rates by the U.S., increases the cost of hedging. So what we could see is a lot of that savings that sits in the U.S. going back home and being reinvested in domestic countries, further boosting the case for growth, for investment, and for trade in all sorts of countries outside of the United States.
Certainly big changes underway in regards to that. Well, Bill Campbell, great to have you, DoubleLine Capital Portfolio Manager.